Alright guys, in here on our news from Times Tabloid, it says XRP reacts as Ripple burns over $500 million tokens. Right? Now, what if I told you that over $500 million just vanished from the crypto market in a matter of days, completely authorized by Ripple? It sounds like a massive security breach or a worst case scenario panic move, right? But the reality is far more calculated. We are looking at some of the most dramatic on-chain data of the year. A massive movement has been spotted on the XRP Ledger, where Ripple officially wiped out over $539 million worth of tokens from circulation in a single 30-day window. The XRP army is completely divided on what this actually means. Is this a sign that institutional demand for Ripple's ecosystem is drying up, or is it a masterclass in global liquidity management that will eventually shock the market? So in this video, we are pushing past the surface level panic and breaking down exactly what happened behind the scenes. So let's start with our very first question about why did Ripple move to destroy $539 million worth of RLUSD stablecoin in just 30 days. To understand what's going on, we have to look directly at the on-chain footprints left on the ledger. According to reports circulating on X from major tracking platforms, Ripple went on an absolute burning spree with its RLUSD stablecoin. They pulled roughly $539 million out of circulation. The data reveals that the most intense activity occurred in a strict window between June 2nd and June 12th, marking the longest continuous daily burning streak since the stablecoin officially went live. In fact, on one single day, June 3rd, Ripple obliterated a staggering $75.1 million in a single move. Now, here comes my opinion. When you see numbers this massive, your initial instinct might be to worry. But as a market observer, my view is that this is proof of an incredibly healthy, highly functioning network architecture. This isn't a flaw, it's a feature. Ripple is treating their stablecoin exactly how highly regulated, top-tier financial institution treats capital. They aren't letting cash just sit idly in accounts when it could be working elsewhere. It proves that the XRP Ledger can handle massive $500 million scale shifts dynamically without breaking a sweat or causing a system-wide bottleneck. Now, our next question is this massive burn actually just routine capital management? A lot of clarity we have right now comes from prominent developer ecosystem analyst Vincent Van Code. He immediately jumped on X to calm the waters, explaining that this burn should absolutely not be seen as a negative event or a sign of system failure. Instead, he views it as a textbook example of routine liquidity management. When a stablecoin is burned, it frees up the actual cash reserves that were backing those tokens. Financial giants don't like keeping capital locked up if there are better, higher yielding opportunities somewhere else in the macro economy. The beauty of this system is that it's completely reversible. If market demand spikes tomorrow, Ripple can simply mint those tokens right back into existence. Vincent Van Code also made a critical point. This is nothing like a crypto whale dumping their assets on an exchange. This is an internal balance sheet adjustment, not market-wide selling pressure. Now, here comes my opinion. I strongly agree with this perspective. Think of it like a massive global cruise ship adjusting its ballast tanks. When a ship needs to navigate different waters, it pumps water in or out to stay perfectly balanced. Ripple is doing the exact same thing with global liquidity. As a market observer, I see this as a sign of operational maturity. They are keeping their balance sheet incredibly lean and agile. It shows they are managing RLUSD with precision, matching supply to the exact requirements of their institutional partners in real time. Now, does this supply contraction signal a drop in institutional demand? Not everyone in the community is celebrating, though. Another prominent market analyst on X, going by the name cexscan, pointed out an angle that has a lot of traders feeling cautious. While it's fascinating to watch Ripple manage this on-chain, the sheer velocity and size of the burns raise a valid question. Was the previous demand for this stablecoin artificially bloated, or is real-world adoption slowing down? If the network actively needed that $500 million in circulation to facilitate cross-border settlements, Ripple wouldn't have destroyed it. The fact the token burns outpaced new minting by over $129 million shows a clear net contraction in the ecosystem's money supply. Now, here comes my opinion. This is a fair question to ask, but my take on it is a bit different. We have to remember that corporate and institutional money moves in massive seasonal waves. It's highly cyclical. Right now, international trade desks and banking partners might just be entering a quieter operational phase, or they are restructuring how they allocate their capital across different ledgers. To assume this means demand is dead is a massive overreaction. Instead of looking at this as a sign of weakness, we should look at it as an absolute stress test of the XRP Ledger's flexibility. The ledger is doing exactly what it was coded to do, scaling down smoothly when volume shifts, ensuring the ecosystem stays completely stable. Now, here comes our overall conclusion. When we weigh the data against the market narratives, the final picture becomes clear. Ripple's decision to burn $539 million in RLUSD is not a structural red flag, nor is it a sign of underlying weakness for the native token XRP. It is the real-time execution of an institutional liquidity strategy. By adjusting the stablecoin supply, Ripple frees up capital reserves to deploy where they are most profitable, while retaining the absolute power to mint more supply the second a Tier 1 bank requests it. The XRP Ledger has proven it can handle massive contractive forces perfectly. As the ecosystem continues to mature throughout 2026, tracking these mint and burn cycles will give us the ultimate roadmap for how global finance utilizes digital assets. The $500 million may be gone for now, but the infrastructure left behind is stronger than ever. And this finally ends our video. Thank you very much for watching, and see you on the next one. Or you might just as well check this recommended video right here.